Today, we're going to talk about a powerful and often invisible force that's constantly shaping our global economy. It's called hot money. Now, it moves at lightning speed, and trust me, if you want to understand the modern financial world, you need to understand how this stuff works.
So let me ask you this. Have you ever seen a news headline about a country's currency surging one day and then just plummeting the next? It sounds pretty dramatic, but it happens all the time. Well, the force behind that's exactly what we're breaking down today.
The answer to that question really comes down to a specific type of capital. We're talking about money that is always on the move, always chasing that next big opportunity around the globe.
And look, this isn't just about giant banks shuffling funds between their branches. We're talking about this huge global pool of investors, speculators really, all moving their capital across borders. And what are they all after? The best possible returns. It's that simple. So this fast-moving, profit-hungry capital, it's got a name that honestly captures its vibe perfectly: hot money. But what does that term actually mean when we get down to it? Well, here's the textbook definition. At its core, hot money is capital that moves super quickly between financial markets. Why? Because investors are hunting for the best short-term returns. The two words you've got to remember here are quickly and short-term. This money doesn't stick around. It has zero long-term loyalty. Let's break down its personality, so to speak. First off, it's all about the short-term win. Forget investing in a company for the next 10 years. This is about making a profit right now. To do that, it chases the highest interest rates it can find anywhere in the world. And that leads to its most famous trait. It moves incredibly fast between markets and countries, and all that speed and all that volume, yeah, that can seriously impact a nation's economic stability.
You know, to really get a handle on this, let's actually follow the money. Let's imagine this capital as a character on a mission. What does that journey even look like?
So here's how it usually plays out. It all starts when a bank, let's say in country A, offers these fantastic short-term interest rates. Hot money spots this from a mile away and just floods in to grab those returns. But then, a bank over in country B offers an even better rate. So what happens? Just as fast as it arrived, that capital gets pulled out and races over to the new, more profitable spot. It's just a constant, high-speed chase for the best deal.
But here's the thing, this high-speed chase doesn't happen in a vacuum. The rapid entry and, just as important, the rapid exit of so much capital creates these huge economic ripple effects. So let's take a look at the consequences.
Okay, here's one of the biggest and most direct impacts: exchange rates. When all that hot money pours into a country, the demand for that country's currency shoots up. That strengthens its exchange rate. But when that same money suddenly flows out, the exact opposite happens. Demand plummets and the exchange rate gets weaker. This kind of volatility can make a country's exports suddenly way cheaper or way more expensive overnight, and that can really shake up its entire economy.
And the risk isn't just to the currency, it's to the banks themselves. As one of our sources puts it, if this money is pulled out on short notice, the bank can suddenly face a massive shortage of funds. This is what you call a liquidity crisis, when an institution just doesn't have the cold hard cash on hand to pay its bills. It's a really dangerous spot to be in. I know, this can all sound very high-level and abstract, but it is so crucial for understanding the global economy. It helps explain the why behind so much of the market volatility we see on the news every single day. So let's just quickly recap the main points. First, hot money is always chasing the highest short-term interest rates it can find. Second, all that rapid movement can be a double-edged sword, either strengthening or weakening a nation's currency. Third, it can create some really serious liquidity problems for banks. And finally, if you can get a handle on this flow, you can start to make a lot more sense of all that global market volatility. And all this really leaves us with a huge question, especially in our hyper-connected world. Is hot money a vital engine for growth, efficiently putting capital where it's needed most? Or is it really just a dangerous source of global instability? Something to think about. Thanks for joining us for this explainer.